Ever wondered what it really means when your debt is charged off? We're here to debunk some common misconceptions about credit charge-offs. One of the most prevalent misconceptions is that a charge-off means you no longer owe the debt. This actually is true. In reality, a charge-off means that the creditor has given up on collecting the debt from you and has written it off as a loss on their financial statements. They will be partially reimbursed on their taxes. Once they try to collect now, it's considered double dipping or being paid twice. And you will need to file the appropriate forms. Another popular myth is that a charge-off will no longer impact your credit score. This couldn't be further from the truth. A charge-off can have a significant negative impact on your credit score. It stays on your credit report for 7 years, from the date of the first missed payment that led to the charge-off. You might also think that once a debt is charged off, creditors can't collect on it anymore. This is not a myth, but you need to know the proper steps to take and the proper forms to file. Or collectors and creditors will still attempt to collect on the debt or sue for the amount owed. Furthermore, some believe that paying off a charged-off debt will remove it from their credit report. Again, this is a myth. Paying off a charged-off debt will change its status to paid charge-off, but it won't remove it from your credit report. However, it may look better to future lenders than an unpaid charge-off. Finally, there's a misconception that creditors will not try to collect on a charged-off debt more than once, but most do attempt this, and it's fraudulent. It's essential to know how to safeguard yourself, as some creditors might try to exploit the situation. Today's video will guide you on how to handle such scenarios. These misconceptions can lead to further financial issues, so it's crucial to understand what a charge-off truly means. Now, let's dive into the actual process of a credit charge-off. Imagine you have a debt that you haven't been able to pay. After roughly 180 days or 6 months of non-payment, your creditor, who could be a bank or a credit card company, may decide to charge off your debt. But what does this mean exactly? Well, in simple terms, the creditor is declaring that they believe the debt won't be paid, and so they write it off as a loss in their financial records. This means your debt is gone. The creditor has adjusted their financial ledger and will be credited through taxes by IRS. But historically, the creditors have continued to seek payment themselves. This is called double dipping or being paid twice. Now you might be thinking, so what does this mean for my credit history and future borrowing ability? Well, the impact is significant. A charge-off is a negative mark on your credit report and can stay there for 7 years. This can make it more difficult for you to secure loans or credit in the future. Lenders see charge-offs as a red flag, indicating that you have a history of not paying your debts. Furthermore, the charged-off debt may continue to accrue interest and late fees, increasing the amount you owe, even though this is illegal. And if you thought the charge-off process was a silent affair, think again. The creditor will likely report the charge-off to the credit bureaus, which means it becomes part of your credit history. In essence, a charge-off is a serious financial matter and not something to be taken lightly. It's not an easy escape from debt, but rather a move that signifies a breakdown in the repayment process. It's a last resort for creditors, and a predicament that can impact your financial health for years to come. So, while a charge-off might seem like an easy escape, it does carry significant consequences. One important player in this process is the IRS Form 1099-C. Let's decipher its role. The IRS Form 1099-C is a crucial document that comes into play when a debt is charged off. This form, also known as the cancellation of debt form, is something that creditors can file, but not required with the Internal Revenue Service when they decide, for whatever reason, that they're not going to be able to collect the money owed to them. Now you might be wondering, why would a creditor decide to do that? Well, there could be many reasons. Perhaps they've tried and failed to collect the debt, or maybe the debtor has declared bankruptcy. Whatever the reason, when a debt is charged off, the consumer needs to do their due diligence, because it transforms, like a financial chameleon, into something else, a taxable income. Yes, you heard that right. If a creditor forgives or cancels a debt you owe, the IRS considers that forgiven debt as ordinary or gross income. And as we all know, income is taxable. That's where IRS Form 1099-C comes in. It's the form that creditors use to report the cancellation of a debt of $600 or more. So, if you've had a debt charged off, you should receive a copy of Form 1099-C from the creditor. If you don't, it's a good idea to request one. Why? Because it's in your favor to report that canceled debt on your income tax return. It's crucial to understand that this transformed debt, now considered as income, is not something that should be reported on your credit report. In short, the IRS Form 1099-C is a key player in the charge-off process. It's the document that officially signals the transformation of a debt from an amount you owe to an income you've received. It's a clear sign that the creditor has given up on collecting the debt and it's now in the hands of the IRS. Remember, the IRS Form 1099-C is a key part of the charge-off process, so stay informed. Inaccuracies in credit reporting can be a major issue. Let's tackle this head-on. In the world of credit reporting, accuracy is king, but unfortunately, it's not always the case that everything is reported correctly. One common inaccuracy involves a debt being listed as both a collection and a charge-off. This, my friends, is inaccurate. Here's why. A charge-off is when a creditor has given up on trying to collect an unpaid debt and marks it as a loss in their accounting books. It means that it's unlikely the creditor will continue trying to collect it. On the other hand, a collection is when a creditor sells your debt to a collection agency who then tries to collect the debt from you. Historically, this has happened after the debt has been charged off. So, a debt can't be both a charge-off and a collection at the same time. Now you might ask, what if I find such inaccuracies on my credit report? Well, you have the right to dispute them, and do not dispute online. The Fair Credit Reporting Act gives you the power to challenge any information on your credit report that you believe is inaccurate or incomplete, or can't be verified. So how do you go about this? Firstly, you should contact the Credit Bureau Consumer Reporting Agency that provided the report. They're legally obligated to investigate the items you dispute. The CRA will then contact the company that provided the information, and they're required to investigate your dispute as well. Secondly, reach out to the company that provided the information to the CRA. If they agree that there's an error, they must notify all the credit bureaus so your report can be corrected. Remember, it's your credit report, and you have the right to ensure the information on it is accurate. Don't hesitate to fight for that right. Staying vigilant about your credit report can help you spot and correct these inaccuracies. After all, it's not just about numbers and data, it's about your financial health and future. So, keep an eye on your credit report, and don't be afraid to stand up for accuracy. Did you know that you can convert a charge-off into income? Here's how. When a debt is charged off, it should just disappear. But the debt still exists, and the creditor has decided it's unlikely to collect and has removed it from their accounts receivable. This is important to understand. You see, the Internal Revenue Service, or IRS, requires creditors to file a form known as 1099-C once they charge off a debt. This form should also be provided to the consumer, but very rarely is. So what can we do with this form? Well, this is where the conversion process begins. The 1099-C form essentially declares the charged-off debt as canceled, and this canceled debt then becomes part of your gross or ordinary income. It's important to note here that income is not reported on a credit report, which can be a huge plus for your financial health. But how does this work? Here's a simplified example. Let's say you have a charged-off debt of $5,000. Once the creditor files a 1099-C form, this $5,000 is considered as canceled debt, and is then added to your gross income once you claim it as such on your taxes. It may seem counterintuitive, but adding this to your income can actually benefit you. Firstly, it helps in cleaning up your credit report. By converting the charge-off into income, you're essentially removing the charge-off from your credit report, which can improve your credit score immediately. Secondly, while you might have to pay taxes on this income, the tax rate is likely lower than the interest rates on your debt, especially if it's credit card debt. This can potentially save you money in the long run. It's always a good idea to consult with a tax professional or CPA to understand the implications of this process on your unique financial situation. And if you want to know more or need us to delete your charge-off, contact us at dwayne@dmsync.ltd or 1-800-467-1650.